It's 1 minute after. All right. Thank you all for joining Mortgage 101. This essentially is a quick webinar just on how the process works, how to get started, what is a mortgage, how do I qualify if we're looking to buy a home. So, a little bit about me. I'm Danielle Anderson. I am a mortgage lender based here in Arvada, Colorado. I got into mortgage lending because I am passionate about house hacking and somebody can make money off of their home. So, if you have any interest in how to make money off of your home, you can also put in the chat there, and I can send you a link after this to the recording of House Hacking 101, how to have somebody else pay your mortgage payment so that you're not paying the whole mortgage payment. And we'll talk very briefly during this presentation on house hacking, but this is more designed on what does the process look like. And then I am passionate about helping first-time homebuyers get into the game. Homeowners have 40 times the net worth of renters. And so I am wanting to change the average age of 40 as a first-time home buyer to more like back to 27, like it was 10 years ago, just to, sorry, oh, I'm so sorry. Just so I'm sorry, homeowners have 40 times the net worth. So if we can get into the game earlier, that is going to help that net worth grow. So who is Guild? Guild Mortgage is the company that I work for. Essentially, they are a mortgage lender, and we are a correspondent mortgage lender, which means that we sell directly to Fannie Mae and Freddie Mac, but we also shop all the other banks like Wells Fargo, BB&T, SunTrust, Chase, etc., to try to get the best deal for clients on interest rates. We're also the third largest mortgage servicer in the United States. And why I love that and love that for you as a first-time home buyer is that our name is actually on the mortgage statement every single month after you close. I've worked for two other mortgage companies that's not true, that after you close, your lender sends it off to a different servicer and then they hold the mortgage. Why I think that's so powerful that we get to hold your mortgage is me as your mortgage lender is truly your lender for life and can see your servicing history. We can easily do refinances with very low cost. And we can even do crazy fun, different loan terms that most places can't. So, like, for example, the typical loan term is 30 years. But if you refinanced, or if you bought 2 years ago and you want to refinance and you want to keep your loan term of 28 years, here at Guild, we can do that, which is really cool. And then we also have a local team that understands Colorado home ownership programs, and in particular, the Colorado down payment assistance programs, which really helps first-time home buyers get into the game. So, where do we even start when we're thinking about buying a house? Really, it starts with something called a napkin pre-qualification, and that's my term that I coined for it because we don't need a lot of information from you. It's really just a 15-minute phone call before you start doing docs, before anybody pulls credit. Sometimes I think that people think that we're scary as a lender, and we're not. We want to help you get a game plan, whether it's 6 months from now, a year from now, together to help you buy. So it really just starts with this napkin pre-qualification to try to get into the game. So the napkin pre-qualification, I'm going to ask you questions like, where do you work? How much do you get paid? How do you get paid? Are you hourly or are you salary? Are you W-2'd or are you self-employed? Like, do you work for a company or do you make money yourself from your own company? Because that really changes what documentation I'm going to ask for and how you qualify. So income is, a major part of that. Then I'm also going to ask you questions about how much have you saved up for a down payment? Do you have no dollars saved up? Or do we have $5,000 in your bank account, but we really only want to use $1,000? A common misconception among first-time home buyers is that we need 20% down. You do not. And I'm actually going to show you an example of how you can literally buy a house in Colorado for $1,000 out of pocket. And then let's just say on that napkin pre-qualification, maybe you're hourly and your hours vary and they're really, some weeks you make, or you work 40 hours a week, other weeks you only work 28 hours. And you've only been there for 3 months. It might be like, hey, Sarah, you don't qualify now, but in a year when we've got state when that income has stabilized, then we can start using that income. Um, so I'm going to be able to give you from that 15-minute initial napkin pre-approval or napkin qualification from the get-go, a roadmap of how do we get qualified. So my motto is if not now, how? So you would get a detailed letter, or not letter, but an email of do we need a cosigner possibly because our income isn't there? Maybe you started working 2 jobs, but we don't have 2 years of history. So in August of 2027, you qualify because then we'll have 2-year history. Typically, after this first 15-minute phone call, I have what's called a yellow, red, or green light. A green light's like, okay, based on what you're telling me, we should be good to move forward and buy a house. A yellow light is like, okay, I think we're good to go, but I'm going to need a little bit more information from you. For example, maybe you're self-employed. Self-employed, I calculate your income based on your tax returns. And so I'm going to want to see your tax returns in order to know what is it, what income can I actually use? Because truthfully, you don't even know what income I can use because let's just say you had gross sales of 150,000, but you've written off your truck payment and you maybe had to pay an employee, etc. So I won't know that until I actually look at your tax returns. And then I also have a red light, and a red light is like, ooh, not now. That might mean that you have a 480 credit score, and our next steps on that roadmap might be, okay, we need to talk to a credit repair specialist, or you yourself need to repair your credit. Maybe there's some collections that we need to handle. It, your next step is to get your credit score at least over 550. Ideally, if you need a down payment assistance program, 620. And we're going to let you know what the steps are to get it there. So this little QR code here on the screen is if you're interested in just a napkin quick pre-qualification of, hey, do I qualify now? Or what steps do I need to get to in 6 months, a year, 2 years? That's what that QR code's for. So feel free to scan it if you'd like to book a free 15-minute napkin pre-qualification of like, hey, what do I qualify for? Um, uh, so after that meeting, if you want to move into onto the next steps of like, okay, cool, I think we're good. We have a napkin pre-qualification. Now we move into what's called a pre-approval meeting. During the pre-approval meeting, I'm going to, or before the pre-approval meeting, I'm going to ask for documentation. So like that yellow light client that I was describing of the self-employed. At that point, I'm going to be like, okay, Sarah, you should qualify based on what you said you think you earn, but I'm going to need to see your 2024 and 2025 taxes to average your income over 2 years to see if you actually qualify, or what your actual income is. So that way I know which loan program to put you in. So you're going to send in documentation. We use a secure portal for our clients to send in documentation. And then once I have that documentation, typically a pre-approval from that napkin pre-qualification to this pre-approval meeting can be as quick as 24 hours or as long as it takes that you get us docs. So it might take a week if you can't get something to us until the very next Wednesday or something. But typically we schedule this call on our initial 15-minute chat and we go over your budget. So which program, why I picked conventional versus FHA, what the difference is between an FHA loan and a conventional loan, why we might want one rate versus another. That's all going to be on this pre-approval meeting. And then I'm going to let you know what is your max loan amount that you qualify for. And your max loan amount that you qualify for might not meet the budget that you want. I might tell you, hey, you qualify for 650,000 and a monthly payment at 650,000 is approximately $4,500. You might be like, oh my goodness, absolutely not. I don't want a house for $4,500 monthly payment. And so we would use that meeting to pare down your two goals. What is your monthly payment goal? And what is your cash to close goal? So that way, when you and your agent are out shopping, you're very clear that the parameters that she's sending you homes meets those two major, important pieces. what your monthly payment goal is and what your cash to close is. And then after that meeting, you will have a letter from me that says, hey, you're good up to this, but based on our conversation and your monthly payment that you wanted, to stay under 3,000, this is really the range that you should be shopping in. So myself as your lender and your agent are all on the same page when you go out and shop on maybe your goal is cash to close at under 5 grand. That might mean that we're using a down payment assistance program that we select on that pre-approval meeting, paired with a 1 or 2% seller concession to bring that cash to close down. So you'll know your numbers when you're out shopping. So who's all in the game? Really, the two main players on your team are going to be your real estate agent and your mortgage lender. Your real estate agent does not know all the nitty-gritty information about you, like your income or your credit score. That's all my job as a lender. But a real estate agent is going out to show houses with you. They're going to point out, what repairs might be needed. And then both of us are direct access for questions. And then it's really my job to go over the monthly payment and quote payments for you so that you're very clear on what that out of pocket is. There's a whole bunch of players behind the scenes in real estate, and real estate has a lot of different terms. So obviously, real estate agent, very common. People you meet, your mortgage lender. A lot of times you don't meet me in real life because most of the time our meetings are via Zoom. The home inspector, you typically meet them at the house once you're under contract. The title agent at closing day. And then you meet with your insurance agent, but you don't typically meet them in person either. People that you don't meet that are working behind the scenes. I have a loan partner, a processor, an underwriter that is all working on the loans on the paperwork side after you're under contract. And then an appraiser that goes out to the property where most of the time the clients that are under contract, you're never going to see the appraiser because you don't have to be there when the appraiser goes out. And what an appraiser is, for those of you that don't know, an appraiser is someone that makes sure that the value that you're buying the home at, so the current market and the other sales in that area support that value. So if you're buying a house at 450,000, but everybody else's house in the neighborhood is really 380 and you have no better upgrades, the lender owns a majority of that house. So really that appraiser supports the lender, making sure that so that you're not overpaying for that house. You might have a lawyer. In Colorado, we really don't have lawyers too often in transactions because we use a standard real estate contract. And then the closer, which is who helps prep the closing documents, are all behind the scenes. So typical loan products. You've got your conventional loan, your FHA loan, and a VA loan. A conventional loan is what is a great first-time homebuyer option. You can put 3% down as a conventional loan, but it has more strict debt to income ratio guidelines, a little bit more strict credit, or if you've got any kind of blunders on your credit from the past, it's a little bit more, it doesn't like that as much. And so you might have a higher mortgage insurance if you're only putting 3% down, where maybe an FHA loan might be better for you because an FHA loan is mortgage insurance is the same rate whether you have a 620 credit score or an 800 credit score. Mortgage insurance is based on the percentage of the loan amount and how much you put down. Now, the one thing to note is that if you have excellent credit, typically you're always going to be in a conventional loan unless you're trying to stretch your budget. Let's just say you're working 2 jobs, but I can only use 1 job. So like you're making good money, but I can only use 1 job. An FHA loan will go up to what's called 55% debt to income ratio, whereas a conventional loan only goes up to 50% debt to income ratio. And debt to income ratio is essentially taking your total debts, your new housing, like your new house payment, plus any student loans, any car payments, etc., divided by how much income you have. So the rule of thumb on really any product, because keeping it under 50% is just easier math, right, is taking your income If you make 120,000, divide that by 12, that's 10,000 a month. Divide by 2, that's 5,000 in total debt that you can have. Then subtract any expenses you already have. Like maybe you have a $500 car payment. So if I take $5,000 minus $500 car payment, that leaves me with a $4,500 housing payment. Let's just say we've got $500 in student loans on there too, which is a lot in student loans, but we're just going to use that as an example. $500 in student loans, then your total housing payment max could be 4,000, just for easy rule of thumb generalization. All of these programs, whether you're conventional, FHA, or VA, all also have access to what's called down payment assistance programs. These programs are designed to help first-time homebuyers get into the game because saving 20% down on a home is out of reach for most Americans. These down payment assistance programs, which I've got a whole different webinar on how to buy a house for $1,000, which goes into more of the down payment assistance. So if after this you'd like to learn more, you can comment in the chat and I can certainly send you the recording on those. But essentially how a down payment assistance program works is a government grant or a program gives you money for your down payment. Here in Colorado, we have something called CHAFA. CHAFA is one of the about 50 different programs that I have here at Guild to help with down payment. So just as an example, they have a 4% silent second, which means that you do not need to pay back part of what they give you at closing until you go and sell your home. Or a 3% grant that you never have to pay back, but the interest rate is higher. So you're not paying interest on that, and it can be up to $25,000 to be used to help you buy your first home, and it's based on your purchase price, or it's based on your loan amount. So we can get it. This is why a one-on-one, getting into the nitty-gritty on your loan options is so important. So if you're interested in learning more about like, hey, do I qualify for this program? Definitely happy to meet with you one-on-one on going over those more specifically. So how does that look? So here's an example of a $650,000 purchase price. Option number 1 right here is not using any down payment assistance. It's putting 3% down. It's at today's current market rate of 6.625%, not paying any points. The estimated closing costs on the high end are about $10,000, $11,000 if we round up. And all included in your monthly payment is your principal and interest, $4,037, a homeowner's insurance estimated at about $244, mortgage insurance because you didn't put 20% down. But that's pretty low compared to what people think mortgage insurance is going to cost. I like to look at mortgage insurance like, yes, it'd be great to have 20% down. However, paying $179 a month for like 4 years, that home price of $650 is probably going to be way more expensive in 4 years than how much you paid in mortgage insurance for waiting to save for that. And then just a little asterisk, mortgage insurance cost is based on down payment. So this is the most expensive mortgage insurance. Now, these people do have good credit, and so the mortgage insurance is also based on your credit score. So if you have like a 700 credit score versus 780, your mortgage insurance can change. And then total monthly payment also includes taxes for a total of that $4,800 for a $650,000 home. Now, I mentioned I am a house hacker, which means I bought my first house by using roommates to help pay for it. So on a 4-bedroom house, and I actually pulled an example for a meeting earlier today on a 4-bedroom house, and that's where I got this $4,800 number. I was using that particular house. We could get $2,100 in rental income because the average bedroom here in this particular area is about a bedroom rent is about $900 on the low end estimate, which could mean that you could live in the house for like $2,700 having roommates. Now, I know roommates aren't always ever, what everybody wants. Or the other thing that I did is I lived upstairs and I took a barn door and separated my upstairs from my downstairs. And then I had Airbnb guests in my basement. and I made about $2,000 a month off my basement just by renting out my room on Airbnb. So different ways to make money off of a home. So what are typical closing costs? One, you have to pay the lender. That's who's giving, if you're not paying cash, you need some additional funds. That's essentially me bringing money to the closing table. And then, so that's about $1,900, give or take a hundred bucks one way or another. Right now, it's, ours is 1934. Then you also have third party fees. So third party fees are what we order on your behalf in order to complete the loan. So in the Colorado market, an appraisal is about $650. But again, this isn't our charge. Um, and so maybe the appraiser has to go out there twice. So maybe that turns from 650 to 850. So at the initial point of the contract, it's kind of just an estimate on it should be around this. Then you also have a flood certificate to make sure that you're not in a flood zone because flood insurance can be super expensive. Um, and then title insurance. So title insurance, essentially, for those of you that don't know what title insurance is a one-time fee, and you are paying to make sure that the home that you're buying has no encumbrances. Oh my gosh, I can't say that word, but there's nothing, there's no negative like payments that you would have to make on the home. So the two largest things that I see as a lender on title or like deal killers on title is one, that seller did a remodel like 3 years ago and just didn't pay the contractor. So the contractor files a lien on that home because they want to get their $30,000 for doing that kitchen remodel. Then, so that lien is with the property and not the person. So that's what's really important to note. And that's why you want title insurance because title makes sure that there's a clear title that that home doesn't owe anybody money upon sale. The other most common thing that I see on title is unpaid child support. So the government files a lien on the home because dad didn't pay X his child support and now he owes her 20 grand and he's not paying her. So in order for her to get the money, she filed a lien or the government filed a lien on the property. So it's definitely important to have. I would recommend it even if you don't have a loan, but you don't have to have it if you don't have a loan. And then we have to record the loan with the county to make sure that the house is yours. So there's fees involved in that. This is on the high end estimate. Again, I always like to estimate on the high end so that there's no surprises at closing. If, I'd rather your fees go down on what I don't control versus up. Then we also have to have homeowners insurance for 12 months. You pay 12 months in advance, and then you also pay what's called an escrow. So that way, in 12 months, let's just say you're closing on the 30th of April. So we pay your homeowners insurance on the 30th of April, but then in 2027, when that homeowners insurance becomes due, we have to have enough money in that bucket to pay them on your behalf. So that's why we start this, what's called an escrow payment. Then you'll also have days of interest, and that'll go up or down depending on the date you closed. In this example, I just have 15 days, but if we were closing on the 30th of April, you'd have 1 day. So numbers to remember, down payment is the money going towards the purchase price of the home out of your pocket that is your ownership of the home. It's your ownership percentage. Closing costs are the costs that are associated with doing the whole purchase. Your title, your appraisal, your lender fees, your escrow, everything all in one. And then your cash to close is these two numbers added together. And I'm going to go back to this estimate because I really only focused on this one. This is an example of a cash to close that's much lower, but the monthly payment is the same. Why? One, because we have an adjustment or other credits of $25,000, and that there is the $25,000 grant, or I'm sorry, down payment assistance program. It's not a grant. This one's not a grant. This is a silent second. So these owners, if they picked this program, would have to pay that $25,000 back But on their initial purchase, it would be a lower cash to close. Now, lower cash to close doesn't always mean lower in cost. Because look here, this is almost $17,000 in closing costs versus 10,000. But this is a great option if they don't have 30,000 to put down on the home. The other third option is something I want to talk to you about on seller concessions. Here in the Denver market, a large majority of homes are getting something called seller credits or seller concessions. Essentially, the sellers are helping pay some or all of those closing costs. So your cash to close is then your down payment plus your closing costs minus your seller credit and then minus that down payment assistance program. So here in Denver, you can get into a home for as little as $1,000 out of pocket, and that's for 650,000. That is what a lot of investors call leverage. And that is like, especially with the house hacking strategy, if you combine those or you like that's where your net worth can really, you can really gain. Perfect. All right. What makes up a mortgage payment? We kind of went through one, but principal and interest, insurance, taxes. If you didn't put 20% down, mortgage insurance, that's your total monthly payment, all in what you owe a lender. The other item that I don't have on here, but if you're buying a condo or a house in an HOA, then you'll also have homeowners association dues. Um, so now we found a house. Okay, so what's next? One, you're going to sign what's called a purchase agreement. The Colorado purchase agreement is the same for every single buyer. You just get to put in different numbers of your dates, your deadlines, how much are you buying the house for? Are you asking for any seller credits? Working with a loan officer up front and going through that pre-approval meeting, you're going to have a strategy with your agent before you put in a purchase what you want to buy, because if your goal is, lower cash out of pocket, you might want to credit instead of reducing that purchase price. Then after you sign a purchase agreement, then you'll meet with me again and we'll do what's called a interest rate lock consultation. Essentially going over multiple options. Where do we want to lock your rate? What program are we good with the program that we originally picked? Great. Moving back, typically on that signed purchase agreement, I'm also involved because you want to make sure that you're comfortable with the cash close and the monthly payment when you're submitting an offer. And then the next step is you're going to have to resend docs to us. And most of the time it's because we started working together in February and you sent me January pay stubs. Now we're under contract in April and we now need to make sure that you're still employed at the same rate, etc. I would say about 50% of clients we don't need updated docs for because we use something called work number or an automated verification of income, and we can just refresh it on the back end. But that's only if your employer qualifies for that. Otherwise, we're going to need updated pay statements, updated asset statements like your bank account, how much is in your bank account, etc. Then, once you're under contract, you're going to have to send in earnest money. Earnest money is typically about $1,000 to $5,000. I would say a good estimate is about 1% of the purchase price here in the Denver market. And that is something that the realtor will put into the contract for you. A lot of Colorado listings already say what they want an agent to submit, but that's everything in real estate is negotiable. Then, most of the time, your realtor is going to give you a handful of different inspectors, and you're going to schedule that inspection. That inspection is just essentially to make sure that the house is good. Like there's not holes in the wall, the roof's not leaking. They're going to point out all the nitty-gritty flaws of the home, and you want them to because that's going to give you better negotiating power with the sellers. Really, the market is going to determine how much you can ask for during the inspection, how much lower in purchase price, etc. Because in some areas of Denver right now or Colorado, there's multiple offers on one home. So there might be a backup offer on the home that you want to buy. And so you might not get any of your inspection items handled. Now, on the other hand, they might have been on the market for 3 months and they're just so happy to have a buyer that you might get this inspection report back and you're asking, a whole laundry list of like, I'd like you to fix the front door scratch. I'd like you to, redo the roof. I'd like you to give me $5,000 for X, Y, and Z of everything that the inspector found wrong. But that is between you and your agent to go into inspection. And then I never order the appraisal before the inspection is complete because an appraisal costs money. It's an additional $650 on a minimum. And so we're going to wait for the thumbs up from you and your agent of like, okay, cool, the house passed inspection, then we're going to order the appraisal. The only reason I would order it quickly is if we're doing a super quick close, or you tell me to, or the agent tells me to, like, hey, we have to do this. Otherwise, I'm typically working with your agent to make sure your contract dates, your inspection dates are first, and then after the inspection resolution time, I have 7 to 9 days after then to be able to order the appraisal and still be within contract. So, what do we as a mortgage lender do with your purchase agreement? We are going to gather all your updated docs and we are going to submit the file to what's called underwriting. Underwriting is pretty much the gatekeeper of yay or nay if you get the loan. Now, I would submit your file to underwriting if there's something a little bit questionable on your income or something at the very beginning, because I want to make sure that we're 100% good. I never want to send you out home shopping if I'm not 100% confident that we're going to walk away with a house at the end of it, or at least from our loan approval, that nothing would ever go through. So there's times that we might submit your file to underwriting prior to being under contract. But definitely after you go under contract, the first step is to really submit to processing, who submits to underwriting. The underwriting looks at all the docs again, confirms that everything is good. Then I'm going to order appraisal, title, work, and insurance. Essentially, it's kind of like a waiting game because when you get pre-approved, you did the hard part up front and all of it's on the initial side. We're just going to be then working behind the scenes. Once underwriting reviews all your income, asset docs, maybe the title work from the title company, they're going to give you back a conditional approval. Essentially, that conditional approval is like, hey, we think we're totally good. We might just need clarification on something. Like maybe there was a large deposit on a bank statement. Maybe we need a little bit of additional paperwork because they had questions on it. So I might be asking you for additional documentation. And then you'll receive the final approval and what's called a clear to close, which means, yay, from the loan side, everything looks great, and you are officially, like, I can tell the agent that you can go ahead and schedule closing depending on the date that you and the sellers want. So another common question that we get is, what's an escrow account? So essentially, if you're putting a low amount down, you are required to have an escrow account. An escrow account is essentially I like to think of it as like a piggy bank for you where your taxes and your insurance go into. So when your taxes and insurance are due, we pull from that piggy bank and pay your balances for you. Now, you'll still get a statement from your tax. You'll still get an insurance statement and a tax statement, but you'll just know that your mortgage company is paying those on your behalf because you're paying monthly for those. If you didn't have an escrow account, you'd have to pay a large balance. Like let's just say your taxes are $3,500, and the reason that an escrow account has been established is it's less risky for a lender if they collect a little bit every month to pay for that instead of one you have to pay one big chunk. And what if you don't have $3,500? So what are the absolute no-nos when you've gone to a lender, you've gotten pre-approved, and then you change something? One, do not take out new debt. That means you can't co-sign for somebody. That means you can't go buy a new car. That means you can't put a couch on credit. So that is like a deal killer because if you go co-sign on Cindy's car, that's your cousin, and now I have that debt payment on you, I have to hit you with that $500 car payment, and it's not even your car. So that could totally change you from qualifying to not qualifying. Also, keep money transfers at a minimum, just because we're gonna have to document every little change in where you're moving money. So it's better to just have it in one account from the get-go. Now, it's not the end of the world, but if you're getting unsourced money, then it then becomes a problem. At the initial napkin pre-approval and pre-approval consult, we're going to go through all of your asset statements. We just don't want any transfers between assets that we do not have. For example, something that would kill a deal, not on a primary residence, but on an investment property, is that you are qualified. We think that we're using your assets. You then, I don't know, spend all your money and you think that Austin is going to give you a gift of $40,000 to close on that investment property. Well, on an investment property, I can't use any gifts. So if that money came in and I could not source it from a valid source, you no longer qualify for the loan. And then gifts are great for primary residence purchase. It's amazing when somebody wants to give you money to buy a house. Um, we always like to just have a plan of how these are going to get transferred. One, to minimize your documentation as well as the gifters. So typically we say, hey, don't send the funds to the person. We're going to send the funds directly to title, just so that we don't have to we have to trace every little deposit, and it just becomes tedious for you and obviously our team as well. But really, it's annoying for you to have to come back to you a million times and ask for more bank statements. So, uh, as a first-time home buyer, you are given two perks. One, down payment assistance programs. There's so many for first-time home buyers. Here in Colorado, the income limits are $210,000 and under. So a lot of people qualify for a down payment assistance program. And then also reduced interest rates. So in most loan programs, if you're a first-time home buyer and under 100% of the AMI, and in Colorado, I've got a little sticky note here. It's 168,000 in the Denver metro area. If you make under 168,000, you don't have what's called loan level price adjustments. So if you have a 720 credit score versus 780 credit score, your interest rate's still great because there's no LLPAs. And so that's one of the biggest incentives to a first-time home buyer. And that's one of the reasons that I'm like, buy earlier, too, before you make 250,000, because you're incentivized, but for having lower income. And 168,000 is 14,000 a month. So people that make under 14,000 a month qualify for the reduced interest rate programs as a first-time home buyer. Um, like I was mentioning on seller credit, closing costs can be negotiated. This is going to be where your real estate agent and I help structure that offer. Um, Offering 5K under asking is only about a 30 to 35,000 or 30 to $35 a month savings, but offering full price and asking for a $5,000 seller credit, like you get that $5,000 in your pocket today, or you could use it for what's called an interest rate buy down, where you can lower your monthly payment using that seller's money. And we're gonna, so this is really just an overview of like how to get a mortgage, what a mortgage is, um, and really just wanted to cover the basics. If you have questions on what you qualify for, feel free to shoot me a text and be like, hey, I want to know. You can scan that QR code that says apply today. That comes directly to me. And essentially, that skips the whole process of the napkin pre-approval and it just goes straight into like, okay, you have given me every single work information about you, and I'm going to pull a soft credit pull if you apply on here. So it's not going to hurt your credit. And then we would create a Zoom meeting where we go over your specifics on what you qualify for. If you're just in like the beginning stages and you don't want to, you're like, oh, I'm just wanting to learn a little bit more information, feel free to follow me on Instagram. I do house hacking tips, as well as first time homebuyer tips all the time. And I also have a website called thehousehackplaybook.com where it houses all my house hacking resources to minimize that monthly payment, for you. So I am going to open it up to any questions, comments, at this time, if anybody has anything that they want to ask.
Oh, that was great, Danielle. I just asked, will we be able to get access to this recording just for reference later?
I hope so. If not, I will re-record it. But I like saw like a note. That's why I was like, when I was like chatting, I was like, oh, whoops.
When I
So,
logged in, it said it's recording. So
oh, great. Okay, perfect.
yeah.
Okay, amazing. Yes, it does look like it's recording right now. So that's awesome. Um, was this helpful for you to? I know that you kind of know a lot of things, Rachel, but helpful
No,
to kind of
it's
walk
great.
through.
I always like a refresher on these steps to help pre-qualify even the leads that come through that I send to you to just kind of ask those questions to make things a little bit smoother and encourage them to take steps before even filling up your calendar. So no, I'm always thankful.
Yeah, and I would say, Rachel, fill up my calendar. Like really, because sometimes you don't know everything that I might know to
No,
like be like,
absolutely.
oh, did we ask about a cosigner? Or maybe they have border income, like they're getting income from a roommate. In certain instances, I am able to use roommate income to help boost qualification.
Mhm.
Um, maybe I have different resources than you might have for like credit repair specialists. So maybe like us sending different things, or I'll run a credit repair. So don't ever think that you're wasting my time. Send
Yeah,
me everybody
I
like
definitely will. You've always been so
yeah.
like gracious to